Welcome you all to the subject of business accounting. Today our topic is the nature and scope of business accounting. So, I am Ms. Rasika Harshani from the Department of Human Resource Management, Faculty of Commerce and Management Studies, University of California. So after the end of this lesson, students, you should be able to define what is accounting and also what is business accounting. And you should be able to describe the components of business accounting, and you can compare the bookkeeping with the accounting, and you should be able to explain the types of organizations. And you need to identify the parties who are interested in businesses and analyze accounting environment. You should be able to outline the objectives of accounting, interpret importance of the accounting, and finally, you should be able to discuss the categories in business accounting. So these are the learning outcomes under the topic of the nature and the scope of business accounting. So this comes as the first lesson of your subject. So first of all, let's see what's accounting. So before moving into business accounting, let's search what's accounting. So accounting is the language of businesses. By business accounting, any interested party can identify the organization or the business. By looking at the business accounts of the organization or a particular business, any party can understand what type of organization or what type of a business is this. And also, accounting is used to communicate the financial information for the interested parties. So, through business accounting or through accounting, it is able, or it helps to communicate, it supports to communicate the financial information which are related to the business to the interested parties. So all the interested parties can have all the informations regarding the business by looking at the accounts of the business. And also, accounting is a method to convey information about a business to users. And also, accounting is a special method which can use to convey certain special information about the business to its users. So users can be different types of users. There can be owners, managers, employees, suppliers, customers, the governing bodies, the legal authorities, and the general society. So all these people, all these parties can be users in an organization, and all these users can have the required information about the organization by looking at its business accountings, or by looking at its accounting outcomes. So the summary is accounting is the language of the organization or language of the business, and it's a special method or a way or a method to convey, which can be used to convey and communicate several information about the organization to its users. So accounting can be used as a method to convey information about the organization or the business to its relevant parties or for its users in the environment. So those who are interested in the organization or those who are interested on the business can use the accounts of the business to have several informations. So there are several definitions given by several parties about accounting. So American Accounting Association has defined accounting is the process of identification, measuring, and communication of economic information for enabling the users to arrive at judgments and decisions. So this is kind of economic informations which enable the users to get several judgments and decisions. So it's identifying, measuring, and communicating the economic information to get decisions of the organization. So then, American Institute of Certified Accountants has defined accounting is an art of recording, classifying, summarizing, and interpreting the results of the transactions and events which takes finance from fully or partly. So where accounting is the art of recording, classifying, summarizing, interpreting the results which comes from the transactions which involves finance fully or partially. Therefore, business accounting can be explained as the process of recording, summarizing, reporting, and analyzing the required financial information relating to the economic events of an organization to the interested users for making decisions. So by looking at these two definitions given by two bodies, we can create a common, a unique definition for accounting. So once again, it is the process of recording, summarizing, reporting, and analyzing the required financial information. So not all information, required financial information relating to the economic events of an organization to the interested users for making decisions, for making several decisions which is applicable to the organization. So now let's see what are the components of basic accounting. So now let's see what are the basic components of accounting. So there are several basic components which comes under the basic components of business accounting. So the first thing is recording. The first component is recording. So it is to make accounts, to work with accounts. First, the organization needs to record all the transactions which occur in the organization. So without recording them properly, cannot do anything with these information. Recording. So nowadays, the computer systems has been deployed to record these informations automatically. So in past, in a few years back, all the recordings should be done manually, but now the computer systems or the computers has been deployed or used to record all these transactions automatically in their system. So recording is easy now by comparing with the past days. Nowadays recording is very easy because the system captures all the transaction occur within the business, within the organization. So there are several special accounting systems or packages or systems to record all these transactions in the organization. So the first component is to record the functions or the record the events or the transactions which happens in the organization. So it's the first basic component of accounting. So the main purpose of recording is to create the accounts, create the required accounts in the organization. So without properly recording all the transactions, the required accounts cannot be created. And then the second component is summarizing. So in recording, we have recorded all the things which occurs in the organization. But as the second component says, after making all the records, we need to summarize what we have recorded. So we cannot take all the information that we have recorded in our books or recorded in our systems. After recording, we have to summarize these transactions for several categories. So without summarizing the information, we cannot have an idea what type of a thing is this, what type of a result is this. So after recording, then the organization must summarize the records, summarize all the transactions which we have recorded previously. So in the summarizing stage, we are going to classify the data, classify all the information into several categories. So it can be sales information, purchasing information, production information, distribution information, information about the staff, employees, and the general expenses, general income, the assets, the liabilities, all the things, all the transactions we need to classify into several special categories once we have recorded all the information. And then after summarizing, we need to analyze all these information. So after you have been summarized all the information, you must have a meaningful conclusion by looking at this information. So there can be positive and negative things with all this information, but you have to have a meaningful conclusion, meaningful idea, or a meaningful decision by looking at this summarized information. So business accounting helps in doing this comparison, doing this analyzing. So under accounting, after you have summarized, then you can analyze all this information to have a meaningful conclusion. So your conclusion can be positive or negative, so it doesn't matter. But after summarizing, you can have a clear idea, clear analysis on your organization's transaction. So this analyzing stage or this analyzing component helps you to compare all these figures with one another. So after comparing, you can have your profit, your cash, your sales, your assets, your liabilities, and your incomes, your expenses. Likewise, after analyzing, you can have all the conclusions, all the summary results, all the final results of your transactions which which took place in your organization for a given period of time. So in the analyze stage, you can have the final conclusion of your organization or the final performance of your business or the organization. So accounting provides quantitative information, so not qualitative information. Accounting always provides quantitative information of the financial nature to both the owners of the users of the organization. So by looking at this quantitative information, the organization can take proper decisions about the business, proper meaningful decisions and conclusions of the organization. So decisions or the meaningful conclusions cannot be done if you didn't properly record information, summarized information, and finally analyzed those information. So these three components are very much important if the business want to perform well or if the business want to take proper decisions for the organization. So first you have to record and then to summarize, and finally you can analyze to have the proper decisions which are related to the organization. So then after explaining all these things, I will give you a small question for you. Then now you should be able to tell or you should be able to answer the first step in the business accounting process is what? Is recording. The first step in the business accounting process is recording. So no summarizing, not interpreting. The first step of the accounting process must be recording. So without properly recording all these transactions, you cannot do anything. The organizations cannot proceed anything without recording all the informations properly. Therefore, the first step in accounting process is recording all the transactions which taken place in the organization within a given period of time. Then let us learn about this bookkeeping. So this is very common. This is a common term, bookkeeping. So it is recording all monetary transactions appropriately classified in books, on cards, disk, or combination of these things. So it is an activity of keeping full documentations of every single financial transaction of the entity to form a base for the accounting process. So it is recording all monetary transactions in appropriately classified books. So there can be several books classified into several categories. So bookkeeping is recording all the monetary transactions in these classified books. So it can be books, it can be cards, or it can be systems. There can be categorized or classified systems. So bookkeeping is recording all these monetary transactions. So not all transactions, only monetary transactions on these classified books or classified systems. So it is the stepping stone of accounting. So it's the starting point of accounting. It is the starting point or the stepping stone of accounting. So, when we are considering these two processes, accounting is much wider and analytical than bookkeeping. So, bookkeeping is the starting point or the stepping stone. So, when it comes to accounting, it is much wider and analytical than bookkeeping. So, bookkeeping helps to start the accounting process, but the accounting is a larger area or a larger or a wider analytical thing than bookkeeping. So bookkeeping is a part of accounting. So not the entire accounting. Bookkeeping is the part or the initial section of the accounting. So it creates the base for accounting. So without bookkeeping, without having a bookkeeping, you cannot done accounting. So it's the starting point and it's a part or a base of the accounting. So then we can compare this bookkeeping with accounting. Bookkeeping and accounting. So it is an activity of recording the financial transactions of the company. So bookkeeping is recording the financial transactions of the organization. But accounting is orderly recording, reporting the financial affairs of an organization for a particular period. So in the accounting, it does not just record it, but it's report. It makes several reports of the all the financial activities or the affairs happen in a particular period of time. So bookkeeping is always a subset of accounting, but accounting is the language of business. So by looking at the books, by looking at the records in your books, so we cannot take a proper decision. So bookkeeping doesn't allow you to take decisions, but accounting allows you to take proper decisions. So at bookkeeping, you cannot prepare financial statements. So at books, you are just recording all the transactions. At bookkeeping stage, you are not going to prepare any financial statement. But at accounting, preparing financial statements is a one part in the accounting process. So preparing financial statements is not the only thing which accounting does. It's another part of accounting. So accounting process goes beyond preparation of financial statements. But in accounting, you are going to prepare all the financial statements and proceed with them. But at the bookkeeping stage, you cannot make any type of a financial statement. So at bookkeeping, you can use journals and ledgers as tools. You can use the journal entries or the ledger entries as tools. But in accounting, you can have your balance sheet, the profit and loss account, the cash flow statements, your manufacturing accounts likewise. Final financial statements can be prepared at this accounting. So not in bookkeeping stage, at the accounting process. So ledgers and the journals are the only tools which can use for bookkeeping. So now let's move into a business. So up to now we have discussed what is accounting. So not business accounting. We have discussed about accounting. So now we are moving to introduce what is a business, because we are going to learn business accounting. So first we learn about accounting. So now we are moving into the business, the term of business. So later we can combine those two terms as business accounting. So first we have learned what is accounting, and now we are going to learn what is a business, and then later we can combine all these two concepts into the main component, into the main discipline. So a business is an economic activity which is related to continuous and regular production of distribution of goods and services for satisfying human wants. So as you all know, a business is an economic activity which continuously producing and distributing several goods and services to satisfy the human wants in the society. So there is another definition for the business. So it's the regular production or purchase and sale of goods undertaken with an objective of earning profits and acquiring wealth through the satisfaction of human wants. So once again, it says it's production, purchasing, production, purchasing, sale of goods with the aim of, with the objective of earning profits and acquiring wealth through satisfying the human wants. So a business is an entity which produce, which purchase, which sell its goods to undertake or to fulfill the objective of earning profits and acquiring wealth through satisfying the human wants in the society. So the business is always producing, purchasing, selling their goods with the aim of earning profits and wealth by satisfying the human wants in the society. So then what is an organization? So in the previous slide, we discussed what is a business. Then now what is an organization? So it's the composition of individuals and groups directed towards coordinated goals. So when it comes to the organization, there can be several parties combined together to achieve a specified set of goals. Composition of individuals and groups directed towards a coordinated goal. So in an organization, there can be several parties or several individuals or several groups which they have directed towards a common coordinated goals. So there can be several people in the organization who are working with a common goal. So there can be several types of organizations like profit-making organizations and non-profit making organizations like charity organizations. So when it comes to profit-making organizations, there can be solo traders or solo proprietorships where the ownership or the a single person comes as the owner, and no much regulations, no much registration ordinances. A single person or two people like a partnership can run a small business without having much regulations, without having much registration ordinance. One individual, so most probably this is owned by a one person or can be two persons like a partner. So a small level of a small or a small medium small scale organization or small scale business which is which can be run without having much legal entities without having much legal requirements, without having much legal requirements and needs or the registration ordinances. So when it comes to these solo traders, the owner is always an individual. Owner and the controller is same as individuals, or one person, the only person, or the one person is coming as the owner and also the control of the business, and not having a much legal entity. The formation is not complex, very simple, so it can be a small boutique or a small bakery likewise, and no tax purposes, no income is treated very legally. Also the income can be totally taken by the owner likewise. So there can be several advantages and disadvantages of solo traders as well. And when it comes to partnership, so if the business is doing by two people, owners are coming as two people, and the controller, there are two controllers, then it's a partnership. So it can be from 2 people to 20 people. If there is a partnership, you can have from 2 people to 20 people. So it can be a small scale or a medium scale organization or a business. So can be run under the registration under the register of partnership agreement. So there should be an agreement between the partners. So how they are investing on the business, so how they are taking the profits, so what are the other benefits likewise, so how they are working with the business likewise, there should be have a partnership agreement between the partners in a partnership. So partnership is also not a separate legal entity. Each partner is fully responsible for the debts and the liabilities. So like a solo trader, the partners also fully liable for its debts and liabilities. So no partners and the business are two entities. Those two entities are considered as a one entity in the court of law. Therefore, the partner's business is unlimited. The liability of the partners is unlimited. So once when there is a thing happen, where is a liquidation happens, all the partners are unlimitedly liable for its debts and liabilities like a solo trader. So again, there can be advantages and disadvantages. So there can be 22 to 20 individuals, and the main motive is the profit, and there is a common goal, and not a legal entity. So the partnership owners and the business are not treated as two entities. Those two are treated as a one entity, and it's very easy to form. Like a solo trader, you can easily form a partnership and can run a business. So then the companies. So companies are treated as a separate legal entities without having its shareholders. So when there is a company, there are two entities, the company and the shareholders. So shareholders are treated as a one entity, and the company is treated as another entity. Therefore, the liability of the shareholders are limited. So not like solo traders and partnerships, the shareholders' liability is limited in a company. So by forming a company, the company can gather a huge amount of capital by issuing its shares to shareholders. The management of the company is done by a board of directors, and all decisions are taken in this director board. So there can be so under the Act number of 7 of 2007, the Companies Act, there are three types of companies like limited companies, unlimited companies, and companies which are limited by the guarantee. So the Companies Act is number 7 of 2007. So under that act, it described three types of companies like limited, unlimited, and companies limited by the guarantee. So what is mean by a limited company then? So the business is owned by a group of people who do not want to have unlimited personal liability. So in a limited company, the liability of its shareholders are limited again. So because the company has its own legal entity or the legal identity, the liability of its shareholders are limited. So the liability comes, the maximum that the owner can lose is the money that they have invested in the business. So the liability comes, the maximum liability comes as the amount which they have invested in the organization. So that's the maximum liability that they can have. So in limited companies, the liability of the shareholders are limited. So it limited its limits to its invested capital in the organization. So the owners are not, or the shareholders are not personally responsible for the debts of the organization or the business, or the personal assets are also not liable for the debts and the liabilities of the company. And when it comes to unlimited companies, their liability goes beyond its invested capital in the company. So they are personally, or their personal assets also liable for the debts and the liabilities of the company. So the shareholders' liability goes beyond their invested capital. So it goes towards or goes above its personal wealth, personal assets, and the other assets of the shareholder. So in unlimited companies, the shareholders' risk is higher. The shareholders' risk is much higher than the limited companies. So then companies limited by guarantee. So in these type of companies does not have any shares or shareholders, but it is owned by guarantors who agree to pay a set amount of money towards company debts. So in this type of companies, there is no shares or no shareholders, but there are guarantors who have agreed to pay a set amount of a specified amount of money towards the company's debts. Or the personal finance of the company's guarantors are protected, but their personal assets are protected, but they have agreed a specified amount to be paid if there is a liquidation problem. So they will be only responsible for paying company debts up to the amount they have guaranteed or they have agreed. And then the state corporations. State corporations are also named as boards, authorities, even though some state corporations are incurring losses. So, as you all know, there are several state corporations in Sri Lanka as well, but most of them are not earning profits, most of them are incurring losses, but they have formed as non-profit organizations. But please be remember, companies limited by the guarantee or the state corporations have been established in non-profit motive organizations. So their main aim is not to earn profits, but they are operating to have to fulfill another requirement of a society. So they are non-profit making organizations. So their main objective is not to earn profits. Their main objective is to provide a certain service to the society, but they can have profits. But most of the state corporations in Sri Lanka are incurring losses. So the government is maintaining these state corporations by assisting and providing all the funds, and these state corporations have established to provide social benefits to the society. So the main aim of establishing state corporations is to provide social benefits to the society. So like Sri Lanka Water Board, Sri Lanka Railway, Sri Lanka Transportation Board, likewise, those corporations are providing a service than earning profits by them. Then the cooperative societies. So once again, non-profit making organization. So it's a voluntary association of individuals having common needs who join hands for the achievements of common economic interests. So a set of volunteer people have get together and form a cooperative society to fulfill a common economic interest. So the main objective is to serve the poorer sections of the society through principles of self-help and mutual help. So their main interest is to help the poorly maintained people in the society, and also to provide support to its members. So since the volunteers are getting together and forming this, the second main objective is to provide support to its volunteer members. Nobody joins a cooperative society to earn, so their main aim is not to earn profits. So people come as groups and with their individual resources, and they are utilizing them to best possible manner and derive some common benefits out of it. So a set of volunteer peoples come and get together, and they bring their personal resources as well. And the first thing is to help the society, the poorly maintained society, or the poorly maintained people in the society, and also to provide support to its voluntarily participated members. So they are again not for earn profits or to provide a particular benefit or a particular service into the society. So these cooperative societies also comes under the non-profit making organizations. So now let's see who are the parties interested in business. So there are several parties, several individuals, several bodies who are connected with an organization. So not only owners and employees and customers. There are several parties who are connected with an organization, and those are treated as stakeholders or the users, and these users can be categorized into several categories. The parties who are interested, parties who are work with the organization. So first section can be the owners, shareholders, or the partners. Owners. So those who have invested money, those who have invested their money to the organization, those who have bought shares of the company. Likewise, there can be owners, partners, and the shareholders in an organization. And there can be lenders. So lenders means who are giving financial support and assistance to the organization. So there can be banks, financial companies, leasing companies, and debenture holders who provide you financial assistance, financial support to run the organization. And the third category or the third type of users comes as the management, those who are running or controlling the business. So not the owners. Owners also can be at the management. Management means those who are running, maintaining the operations of the business. So owners also can be in the management. Managers can be comes as the owners. But the management is those who are running or the operating the business. So there can be directors, chief operating officers, finance directors, divisional heads, department heads, functional heads. Likewise, those who are managing, those who are making decisions in the organization. And then the third category of users comes as employees. So there can be several types of employees: shop floor employees, factory employees, office employees, employees who are in the trade unions, temporary employees, casual employees. Likewise, the fourth category of users comes as employees. So those who are working in the organization for earning a salary, for gaining a salary. And then the fifth category of users comes as suppliers and other creditors. So those who are supplying raw materials, subcontractors who are providing services, and those who are giving other financial benefits to the organizations like creditors. So those who are supplying the required resources to the organization. And then the sixth category of users comes as the government and the other regulators. So those who are governing the organization, controlling the organization, whether the parties who are controlling the organization by several rules and regulations. So there can be tax authorities, the company register, the stock exchange, the central bank. So the company should obey to all these governing bodies in the country. So without having their agreements, without taking their rules and regulations, any company cannot operate. Therefore, the company should, or the organization should, follow the rules and the regulations given by these governing bodies in the country. The sixth category of users. And then the final category of users is the general public. So the general public also interested about the organization. So they are the people who are buying things, who are consuming the goods and services producing by the organization. Therefore, the general public also comes as the parties who are interested in the business. So there can be political parties, consumer groups, the consumer affair authority, environmental operators, local communities, those who are also interested on the organization. So especially the customers, because they are the people who are consuming the goods and services offered by the organization. So there can be several political parties who are interested, and consumer groups, especially the consumer affair authority, the environmental operators who are looking your environmental practices, and finally the local community. So here we have discussed 7 types of users who are interested in your organization. And then let's move into the accounting environment. So when it comes to accounting or business accounting, there can be the environment, like internal and then external environment. So both the internal and the external environmental factors can be affected to your business accounting process in the organization. So there can be internal factors and also external factors at your accounting environment. So by looking at these all factors, we can subdivide the environment into these few categories. So there can be internal and external factors as well when it comes to the environment. So by looking at all these factors, we can subdivide this environment into sub-environmental categories. So it can be the legal environment, technical and the professional environment, economic and the political environment, social and cultural environment, and the technological environment. So these type of environments, these type of factors like legal, technical, professional, economic, political, social, cultural, and the technological factors comes or affects to your business accounting process in the organization. Therefore, when doing business accounting, when going through this accounting process, definitely the organization must consider on this environmental impacts as well. So environment definitely impacts to your accounting process. Therefore, these categories must be thoroughly addressed. So when it comes to legal environment, all the companies, all the businesses should obey with the legal requirements which directly relevant to that particular company or the industry. So it is the general legal requirement of the country. So each and every organization, it can be a solo trader, partnership, company, cooperative society, all the businesses, all the organizations must comply or the obey with the legal requirements which gives by these legal bodies of the country. So when it comes to employees, customers, production, manufacturing, distribution, all these things are governed by set of rules by the law. So the law has given set of rules to each and every activity in the organization. So when you are doing those activities, when you are operating these activities, you need to follow all these given legal requirements. So without complying, without obeying the legal requirements, any company cannot exist in the country or in the society. So from the business formation to the end, from the beginning to the end of the organization, all the requirements, all the legal requirements has been specified, and each and every organization or each and every business should obey or comply with these given legal requirements. And the technical and the professional environments. So introducing new standards, new accounting techniques will have a direct impact of accounting. So this technical and professional environment can change the technical and the professional environment. So they can introduce new standards, they can introduce new accounting techniques, which directly impact to your accounting process. And then the third environment is economic and political environment. So it is again have a direct impact of the accounting process, because changes in the economy or changes in the government and the decisions on privatization, income distribution, likewise, all these things can be affect to your accounting process. So time to time the governments are changing, the governing bodies are changing, political parties are changing. So when those changes happen, all the things change, and these changes will again affect to your accounting process. So as an example, we can say the tax policies. The new government has imposed a new tax policy to the society. So when those things comes, it also affects to your accounting process. Therefore, economic and political environment also should be also can have a direct effect to your accounting process. And then the social and the cultural environment. So businesses are affected by the social and cultural values, some occasions, some religious festivals, and some religious movements, some religious celebrations. Therefore, the social and the cultural environment affects to the accounting process. So when it comes to your production, your deliveries, your distribution, your marketing, so when you are doing all these things, you have to consider this social and cultural environment of the organization or environment of the society and the industry. So when it comes to Sinhala and Hindu festival, your demand will be high. And in Vesak festival, the Vesak cards, oil lamps, coconut oil demand will be increased. So when it comes to Christmas season, especially the cake ingredients, clothes, gifts, the demand for those things can be increased. So those things also impact for your accounting process, impact to your business operations. And then the technological environment. So the modern technology developments have a major impact to the business. So day by day the technology changes, new things comes, then it impact to the business, it impact to the business operations. So when it comes to technological environment, when it comes to business transactions, so those several things has been very sophisticated level, so not very hard. So now with the technological developments, these accounting things, business operations can be done very easily. So the accounting activities has become more convenient due to the development of computer systems. So as I mentioned earlier, due to these computer systems, the accounting activities, business accounting process has became more convenient and very easy, and preparation of these financial statements also become more convenient in a computerized environment where when compared with the manual process. So with the technological advancements, most of the things has become very convenient and easy. And then finally, the objectives of accounting. So the primary objective is to provide financial information to the users who are keen on a particular accounting unit. So the main objective of accounting is, so as we discussed in the initial slides, the main objective is to provide financial information to the users who are keen on particular accounting unit. So who are keen on organization, who are very interested on the business. So there can be other objectives as well than the primary objective. So other objectives comes as accounting controls and manage the economic resources in the organization. So by keeping all the records for cash, fixed assets, your liabilities, your expenses, your incomes with physical numbers, then it's easy to control and manage those economic resources in the organization. And so accounting helps you to make decisions relate to the usage of economic resources. So by looking at the information, you can have decisions which are applicable to these economic resources in the organization. And this business accounting always evaluates the results of the economic activities of the organization. So especially it is calculated the profit and loss, your balance sheet amount, your cash flows and outflows, your manufacturing expenses. Likewise, it evaluates the results of the economic activities. And also finally, it fulfill all the legal requirements of the organization as well. Fulfilling legal requirements. So, as a legal requirement, companies or the organization should prepare the accounts as per the Companies Act. So, once again, it fulfills the legal requirements of the governing bodies as well. So, the primary objective is to provide financial information, and there can be other specific objectives like controlling, managing, and making decisions on the economic resources, and it evaluates the results of the economic activities, and finally by fulfilling all the requirements which are imposed by the governing bodies in the society. So when it comes to the importance, so why we should have accounting? So what is the importance of having accounting? So these are the reasons for the importance of accounting. So accounting is a social phenomenon. So financial statements provides the information to the investors about the profitability of their investment. So investors are very conscious to invest more in profitable organizations. So this leads to create a lots of profitable ventures, and thereby economy of the country can be developed. So therefore, accounting is important as a social phenomenon. So in order to develop a country, in order to develop a society, we need to have lots of organizations, lots of businesses, and also we should have lots of potential investors who like to invest on these organizations. But the investor, before investing his money, the investor always very much conscious on these financial statements of the organization. So by looking at this financial statement, the investor decide whether to invest or not in the company. So when we can increase the number of potential investors in the country, then it will finally helps to develop the country as well. Therefore, as a social phenomena, we need accounting. And accounting can come as a source of information. So as we discussed earlier, accounting is a mode or a method of conveying, communicating, or a source of information. So by looking at the financial statements, anyone can understand the organization. Anyone can understand the scope or the environment or the business of the organization. So accounting helps to provide important information not only to the third parties but also to the entire set of stakeholders. So not only to specific parties, to the entire stakeholders, it provides relevant information. And also accounting can be used as a mode of control or a tool of control. So by looking at the final results, final accounting results about the income, expenses, your assets, your liabilities, then the management can have decisions. Management can take several decisions to control the organization and the resources of the organization. So now we can move into another subtopic, that is categories in accounting. Categories in accounting. So accounting can be two types. There are two categories under accounting: financial accounting and the management accounting. So in financial accounting, it provides the historical financial information about the enterprise. So it is practice of recording and aggregating financial transactions into financial statements. So in financial accounting, you are going to provide all the historical financial information about the organization. And when it comes to management accounting, it's again a branch of accounting which focuses on the revenues and expenses of the business and as well as the asset usage. So in management accounting, it provides information related to your revenues and expenses, mainly your incomes and expenses and the assets. So what happens for your assets, incomes and expenses? So in management accounting, it majorly focuses on your incomes, expenses and the assets. But in financial accounting, it provides you the historical financial informations like financial statements, or your profit and loss account, your balance sheet, your cash flow statement, your manufacturing account. Likewise, it provides you the historical financial information. But in management accounting, it focuses on the revenues, expenses and the revenues, expenses, incomes and the assets of the organization. So here again, we can compare financial accounting with management accounting. So financial accounting is an accounting system that focuses on preparation of financial statement of the organization. So in financial accounting, they mainly prepare financial statements. So in management accounting, it provides relevant information to the management to take policies, plans, strategies to run the business effectively in a given period of time. So by looking at the figures of revenue, expenses, your income and your assets, it provides the management to take relevant decisions on the policies, plans, and strategies related to these areas. So financial accounting is compulsory. So you should definitely prepare your financial statement. So it's a must. But management accounting is not compulsory. So as you want, if you wish, you can have this management accounting component as well. So in financial accounting, it always So it purely provides you the monetary information only. But in management accounting, it provides both monetary and non-monetary information. And in financial accounting, it provides financial information to the outsider. So they are preparing financial statements to the outsider. So not to the inside, not to the parties who are inside the organization. Financial statements are prepared to the parties who are outside of the organization. So but the management accounting, under management accounting, they are providing information to the parties who are inside the organization and to the parties who are making decisions of the organization. So those who are making decisions on various matters in the organization. So in management accounting, they they assist the managers or the management to take several decisions in various matters in the organization. And when it comes to this time frame, financial statements or the financial accounting in financial statements, they are preparing those things in under a particular period of time. So financial statements are prepared for a particular period of time, most probably for a 1 year. But in management accounting, there is no a specified time frame. So if you wish, you can do it now. There is no a specified time frame for that. So then management accounting is used by only the internal managers. But the financial accounting, under financial accounting, the prepared financial statements are used by the external parties of the organization. So in financial accounting, publishing and auditing those financial statements is a must. So it's a statutory requirement. But in management accounting, the prepared statements, the prepared accounts, and the prepared information are not neither published or no audited by the statutory auditor. So it's purely preparing to the requirement of the organization. So not for any party, not for any outside party of the organization. So under management accounting, all the activities done for the requirement of the management to get several decisions on several matters, but they are not for any outside party of the organization. So then the categories of accounting. Categories in accounting. So there are several categories in accounting as cost accounting and management accounting and financial accounting. So categories in accounting comes as the 3 subcategories: financial accounting, management accounting, and the cost accounting. So cost accounting can be identified as an internal part of the management accounting, and it is the cost details of the goods and services in the organization. So it is important to take the internal decisions in the organization, and it's very much useful to control the cost items in the organization and to get the maximum usage of the resources. So cost accounting comes under the management accounting. So mainly under cost accounting, we are doing we are concerning on the cost items of the organization, and we are trying to control the cost items, and we are trying to maximally use the resources of the organization by reducing the cost of these resources. So under components or the categories, there are two categories under business accounting: financial accounting and the management accounting. And management accounting has another subcomponent as cost accounting. So under cost accounting, what we are doing is we are recording, we are summarizing, we are analyzing all the cost items which are incurred in the organization. So that is the cost accounting comes under the management accounting. So mainly there are two components: financial accounting and the management accounting. So under management accounting, there is another subcomponent as cost accounting, which mainly focuses on the cost items of the organization. So then this is the end of your first lesson, that is nature and scope of business accounting. So in here we have discussed what is accounting, what is a business, what is an organization, and then what is business accounting, what are the basic components of business accounting, and the subcategories of business accounting. And when it comes to organizations, types of organizations and their objectives, and the objectives of business accounting, likewise several subtopics we have discussed under this first lesson, nature and scope of business accounting. Thank you.